This lecture will cover the analysis of the cash flow statement. The corresponding page numbers in the textbook are pages 175 through 183. The cash flow statement helps analysts determine the ability of a firm to generate cash flows and meet future obligations. Reviewing this statement offers insights into the future external financing needs of the firm, as well as their success in managing investing activities and implementing financing and investing strategies. Remember, it is possible for a firm to be highly profitable but not be able to pay dividends, invest in new equipment, repay debt, and ultimately go bankrupt. Positive cash from operations, or CFO, is critical to the success of firms. Cash is needed to satisfy both creditors and investors. Temporary shortfalls can be satisfied by borrowing or other means in the short term, but in the long term, firms must at some time generate positive cash from operations. The example of No Cash Corporation on pages 176 to 178 in the textbook will be reviewed. Sales for No Cash increased from $50,000 to $100,000 from year 1 to year 2, while expenses increased from $40,000 to $70,000. Net income for No Cash Corporation is positive in both years 1 and 2. What the income statement does not show is that No Cash eased its credit policies and attracted lower quality customers. The firm purchased a new inventory line that they sold below cost, and rumors of account receivable and inventory management problems caused some suppliers to refuse credit to No Cash. The balance sheet shows the effects of what has occurred in the firm. From year 1 to year 2, accounts receivable has increased $20,000 and inventory increased $15,000. Accounts payable has decreased $5,000, while notes payable and equity increased $10,000 and $30,000 respectively. The cash account balance remained at $2,000. If we calculate cash flow from operations using the indirect method, we can see that despite the profit of $30,000, No Cash had negative cash flow of $10,000. This is due to the increasing accounts receivable and increasing inventories, while accounts payable decreased. No Cash recognized $100,000 in sales on the income statement, but how much of that did the firm really collect in cash? If we analyze the account receivable account, we can determine the answer to the question. The account receivable balance was $10,000 at the beginning of year 2, and $100,000 of credit sales were added to the account over the year. Since $30,000 is the ending balance, No Cash collected $80,000 in cash. We can do similar analysis with the inventory and account payable accounts. Assuming cost of goods sold is $60,000 for No Cash, purchases of inventory would be $75,000 since we know inventories increase $15,000. The cash payments to suppliers is calculated by analyzing the accounts payable account. See the last calculation on this table. The beginning account payable balance of $7,000 would be increased by the inventory purchases of $75,000, and since the accounts payable balance at the end is $2,000, No Cash paid suppliers $80,000 in cash. No Cash had to borrow $10,000 to continue to operate, and unless the firm can eventually generate cash from operations, they will sell themselves out of business. Using the Sage Inc. information, we will review the analysis of their cash flow statement. When analyzing any firm, 3 key areas should be covered: the analysis of cash from operations, and an analysis of cash inflows and cash outflows. When analyzing cash from operations, or CFO, the analyst should be concerned with the firm's ability to generate consistent and positive CFO. Also look at the causes of differences between the CFO amount and the net income for any single year. Let's analyze CFO for Sage Inc. for the 3-year period from 2014 to 2016. First, notice that net income is trending upward and increased significantly in 2016. Compare the net income to the CFO amounts each year. All other things equal, we expect a firm to generate CFO that is greater than net income, since most firms have significant depreciation, which is a non-cash item. For Sage, CFO was positive in 2014, but slightly less than the net income amount. In 2015, CFO was negative and far below the net income amount. In 2016, CFO has increased to a positive amount and is now greater than net income. Why has CFO differed from net income each year? In 2014, CFO was smaller than net income because of the increased account receivable and increased inventory accounts, combined with the firm paying down accrued liabilities. Increases in assets cause an outflow of cash, as does the decrease in the liability account. In 2015 and 2016, the firm's account receivable and inventories continue to increase each year, and in 2015, the firm pays down both accounts payable and accrued liabilities. The negative adjustments in 2015 have caused the negative CFO. In 2016, Sage was able to generate positive CFO despite the increasing account receivable and inventories, because the firm nearly doubled profits, increased depreciation, a non-cash expense, and borrowed from suppliers, as evidenced by the positive adjustment for accounts payable. We can make an educated guess as to what might be occurring in the firm. It appears the company is in the middle of an expansion, which would explain the increasing accounts receivable and inventories if new retail stores are being opened. This would also explain the higher depreciation amounts if new property, plant, and equipment has been purchased. If net income and property, plant, and equipment were not increasing, the analyst would be concerned that the firm did not manage accounts receivable or inventories well. To analyze the cash inflows and cash outflows, we can prepare a summary analysis of the statement of cash flows. This analysis allows us to highlight where the firm obtains cash and how they use cash. To prepare the summary analysis, we copy all actual cash flows from the statement of cash flows into a schedule that segregates cash inflows from cash outflows. The cash from operations amounts of $10,024, negative $37.67, and $56.29 will be copied from Exhibit 4.4 on page 179 of the book, and was also shown on the previous slide, 416. Exhibit 4.5 shows the actual cash inflows and cash outflows from investing and financing activities on the cash flow statement. I will explain how the amounts are copied from the exhibits 4.4 and 4.5 onto the summary analysis statement, which can be viewed on page 181 of the textbook. For Sage, the CFO from 2016 and 2014 is a cash inflow, while the amount for 2015 is a cash outflow. The net income numbers and the adjustments are not cash flows, but rather the math that translates the net income number into a cash flow number. Looking at the Investing and Financing Activities section, Exhibit 4.5 that you see on the screen, for Sage Inc., we can then copy the dollars received or paid for each of these activities. For example, in 2016, we would copy the $295, $256, and $5,600 cash inflows into the cash inflow section of the summary analysis. The other amounts of negative $14,100, negative $30, negative $15,16, and negative $15,82 are cash outflows and would be categorized as such on the summary analysis. While we are still looking at this exhibit, notice that Sage Inc. spent significantly more for additions to property, plant, and equipment in 2016 compared to 2014 and 2015. This supports our prior analysis that the firm is probably expanding. Exhibit 4.6 is the completed summary analysis for Sage. To complete the preparation of this statement, you can see that each category of cash inflows and outflows has been subtotaled. The difference between cash in and cash out each year is the change in cash, and that should agree with the amount shown on the original cash flow statement. 3 additional columns are included in this statement. Each cash inflow is divided by the subtotal for cash inflows in each year. The same is done for the cash outflows. Let's now go over the analysis of cash inflows. This schedule shows us that Sage generated the majority of cash inflows from operations in 2014 and 2016. This is the preferred method for generating cash. In 2015, all cash inflows were the result of borrowing or stock sales. In 2014 and 2016, Sage did supplement inflows by using debt and stock sales. Where did Sage spend their cash? Look at the outflows section to analyze cash outflows. The firm had to use cash in 2015 to support operations. The majority of cash spent each year has been for property, plant, and equipment, which is an expected and necessary expenditure if a firm is expanding or replacing worn-out plant and equipment. Some debt has been repaid, which is also expected. The firm has paid dividends all years, but appears to have cut the dividend based on the dollar amount shown in 2016. Cutting the dividend may have been a result of the negative CFO in 2015. Firms should only pay dividends when they have excess cash not needed for supporting operations and paying back debt. In summary, when analyzing the cash inflows for a firm, cash from operations is the preferred source of cash. Using external sources of cash year after year should be investigated. When analyzing the cash outflows, the analyst should consider the necessity of the outflow and how the outflow has been financed. It is best for firms to finance short-term assets with short-term debt and long-term assets with long-term debt or issuance of stock. As stated previously, repayment of debt is a necessary outflow. The notes to the financial statements give details with regard to how much debt must be repaid each year for the upcoming 5 years. Analysts should utilize this information in their analysis. Companies should only pay dividends if the company has excess cash not needed for expansion, property, plant, and equipment, or repayment of debt. One final note. While it is more difficult to manipulate numbers on the statement of cash flows compared to the income statement or the balance sheet, there are instances where management has misled users of this statement by recording items in the incorrect categories. An example would be recording operating expenses as capital expenditures so that CFO is higher than it otherwise should be. WorldCom did just that prior to going bankrupt. The other examples listed on this slide are covered in the final pages of Chapter 4.